Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on the word confidence and how it plays out in financial markets. It's been a week in which we've seen a lot of very divergent trends. Let's start off with the pound against the dollar. And what we can see here is, as much as Mr. Johnson has got this very exuberant, confident approach to negotiating with the EU, as his predecessors, Margaret Thatcher, John Major, and indeed long before that during the Bretton Woods period, Harold Wilson learnt, the foreign exchange market is an unforgiving place, and as much as people like confidence, if they think it's going to end up with an adverse situation, so you will pay the price. There's one example. Let's turn over to the next example, which is a table of G7 world government bond yields, 10-year government bond yields. The remarkable thing about this, with the exception of Italy and Greece in the euro area, is pretty much all of those 10-year government bond yields are actually below base rate in the respective countries. So below Fed funds, below Canada's cash rate, below base rate here in the UK, below the Eurozone's, even the deposit rate as far as Germany goes. That tends to suggest that we're not actually believing that the easing which has been announced in the United States and is certainly mooted in the Eurozone and possibly in Japan is actually having much of a positive effect. And that probably tells us where we're at the moment, and also tells us on the other side of the equation something about the lack of confidence that we're hearing from those G3 central banks. Mr. Powell fumbled his appearance this week in the press conference. He wasn't really quite sure what he was signaling, whether he was one and done, how many more Fed rate cuts there might be. And so we ended up with this situation where markets basically turned tail and felt rather aggrieved by Mr. Powell's poor communications. Now, in all of this situation, obviously we've had the announcement overnight that Mr. Trump intends to impose an additional 10% of tariffs on Chinese trade goods. And we've also, in the US, had that announcement that the debt ceiling has been passed and the Fed will end its quantitative tightening program in August. That leaves us with something else to consider, and this is where I think actually something which we need to think about. August is always a bit of a treacherous month. This is the US Treasury's cash balance at the Federal Reserve. One can see during the period when they were basically still not sure whether the debt ceiling was going to be raised, that cash balance was run down. Over the next 2 months, it's the Treasury's intention, via T-bill sales for the most part, to raise that balance back towards the $350 to $400 billion level. That's a big drain of liquidity from financial markets. And for financial markets, which are feeling a little bit queasy at the moment, one would have to start to worry. And I think in this situation where we've got the potential for a very destructive round of auto tariffs, also in the background, though apparently the announcement today on EU tariffs is actually a positive one about beef, but it does leave us in a situation where we're going to have to start to look for more volatility, and we're also going to need to have a look at my very last chart, which is an old favorite. It's the high yield credit average spread versus US Treasuries. And as we can see, we saw quite a sharp widening yesterday. Obviously, we are nowhere near the levels that we got back to either at the end of May or indeed the back end of last year when we went into a blind panic. But if we start to get more problems in terms of dollar liquidity, then I think that's one area which one's going to have to look at very, very closely, particularly if the tariff situation is associated with a fall in oil prices, because oil companies basically constitute a very large part of that high yield index in the US. And that's the thought for this week.